welcome to this explainer. As a market economist, I've got to say, I'm watching a completely fascinating high-stakes collision playing out right now. Global geopolitics and domestic economic data are literally crashing into each other, and it is actively forcing the Federal Reserve's hand. Today, we're going to map out exactly how short-term energy volatility and these long-term inflation targets are playing out on the world stage, because they are creating some massive ripples for both Fed policy and, of course, your portfolios. Okay, let's dive right into this. The immediate catalyst grabbing everyone's attention right now is a single glaring number, 4%. May's headline inflation breached the 4% mark, which officially puts us at a 3-year high. Now, for a central bank that has been actively trying to cool the economy down for what feels like an eternity, this is a flashing red light right on the dashboard. But we really have to look under the hood here. Yes, headline inflation is over 4%, and business prices, they surged by a staggering 6.5%. But the metric the Fed actually agonizes over is core inflation. When you strip out those highly volatile energy prices, we see core inflation sitting stubbornly at nearly 3%. And here's why that is absolutely crucial. Inflation has now persisted above the Fed's 2% target for more than 5 years. It is incredibly sticky. So to make sense of all this, here's our roadmap for the explainer. We'll start with the geopolitical catalyst driving today's headlines, measure its real impact on energy, weigh tariffs against core inflation, look at the Fed's internal tug-of-war, decode their latest dot plot projections, and finally answer the million-dollar question, are we looking at rate hikes or future cuts? Section 1. The inflation crossroads. Let's look at the big geopolitical catalyst. The major macroeconomic shift that just threw a massive wrench into market expectations was this unexpected interim peace deal between the U.S. and Iran. It's a very delicate balance. On one hand, we've got immediate market relief. The U.S. is lifting its blockade on Iranian ports, meaning the Strait of Hormuz opens up this Friday. But there's a serious catch here. This whole thing relies on a really tenuous 60-day negotiation window regarding Tehran's nuclear program. It's essentially just extending an April ceasefire. And man, it is fragile. Israel has already distanced itself from this pact following those recent drone strikes in southern Lebanon. Section 2. Geopolitics and energy volatility. The second this interim deal was announced, commodity markets reacted immediately, practically stripping out the entire geopolitical risk premium overnight. To understand why, you really just have to look at pre-war shipping traffic. The Strait of Hormuz is a massive, massive global choke point, a full 20%. Literally 1/5 of all global crude oil and liquefied natural gas supplies flows through this single narrow passage. Since it was effectively blocked in late February, the pressure on global energy has been immense. But as investors, we have to separate the signal from the noise, right? Markets aggressively priced in immediate normalization, sending Brent crude tumbling down to around $78 and WTI crude to around $75. But the physical reality on the ground tells a totally different story. Physical tanker traffic hasn't fully recovered yet. In fact, U.S. crude stocks just saw a massive 8.3 million barrel draw, and China's crude throughput fell to a nearly 4-year low in May. Industry officials are warning us that a return to pre-war production levels, that doesn't happen overnight. We're talking weeks, months, or maybe even longer. Section 3. Tariffs versus core inflation. Welcome to the macro tug-of-war. Domestically, our economy is trapped in this brutal tug-of-war. The real key is figuring out how these opposing forces balance out. On the deflationary side, and Wilmington Trust's Luke Tilley pointed this out, we have potential near-term energy declines from the strait reopening, plus stagnant home prices and generally weak consumer spending. But pulling hard in the opposite inflationary direction, the current administration is layering on brand new tariffs on metals to replace the old ones struck down by the Supreme Court. Throw in the massive AI-driven demand for computer equipment, plus deregulation and the One Big Beautiful Bill Act, juicing economic demand, and you've got some incredibly potent inflationary pressures fighting back. This tug-of-war creates an absolute nightmare for the central bank. Former Kansas City Fed President Esther George actually hit the nail on the head. She said, quote, "You've got an inflation problem right now, and you have to communicate that. Their resolve around this inflation is their real challenge." The Fed has to decide, are these energy spikes and new tariffs just temporary blips we can ignore, or are they persistent structural threats to the broader economy? Moving to Section 4, hawkish shifts and dovish views inside the Fed. As the committee wrestles with this dilemma, Chairman Warsh is caught right in the middle. He enters the role with a historically dovish reputation and obvious ties to the administration that nominated him. But the reality, He is inheriting a noticeably more hawkish committee that is staring down red-hot inflation data. Economists like Greg Dacko have pointed out that Warsh's biggest challenge isn't steering toward easier policy, it's proving to the market that his decisions are actually grounded in hard economic fundamentals. If he sounds too dovish or looks beholden to political pressures, he risks reigniting concerns about Fed independence, and that could push up long-end bond yields and seriously damage the economy. And this brilliantly illustrates why the committee is so hawkish right now. Listen to former Philadelphia Fed President Patrick Harker. He reminds us that even before the conflict in the Middle East, inflation was already running above the 2% target. The underlying issues, the structural rot creating that inflation, they never went away. A temporary drop in gas prices from an interim peace deal doesn't magically cure a 5-year systemic problem. Section 5, decoding the dot plot. Let's look at the projections. Now, if you track the markets, you know this tool well, but let's just make sure we're all on the same page. The dot plot is a quarterly chart where all 19 members of the Federal Reserve Committee anonymously project exactly where they believe interest rates need to be at the end of this year and into the future. It's essentially our ultimate insider look at where central bank policy is headed. And the shift we're seeing in this dot plot, it's dramatic. Back in March, the median forecast was for 1 rate cut this year. Now, expectations are that the median will move to 0 cuts, just holding steady. But wait, it actually goes further than that. Patricia Zobel from Guggenheim Investments predicts a stark hawkish shift, suggesting several participants will actually pencil in rate hikes as their base case. We might even see some members projecting up to 2 hikes this year. No way are they letting their foot off the brake just yet. Section 6, hikes or future cuts. Let's bring it all together. All of these converging pressures build into 2 vastly diverging paths for interest rates over the next few years. Over the next 60 days, we've got the Iran negotiation window. Depending on how that and the incoming inflation data shake out, Capital Economics' Stephen Brown warns we are more likely than not to see 2 insurance hikes by December or early next year. Conversely, Luke Tilley at Wilmington Trust believes those energy drops will eventually cool things down. He projects that core inflation won't even near the 2% target until late 2026, leading to eventual rate cuts in early 2027. That is a massive, massive gap in expert forecasts. So what is the ultimate takeaway for you as a stock investor navigating this? Look, do not get distracted by a short-term drop at the gas pump. Equity markets are going to be hypersensitive to the underlying core data. Making portfolio adjustments right now requires hedging against the risk that core inflation is structurally sticky. That implies a tighter for longer central bank policy that could seriously pressure your growth stocks while presenting some great opportunities in sectors that are historically resilient to prolonged inflation. I'll leave you with this final thought to chew on as we watch the Fed's next moves. If pre-war inflation was already sitting stubbornly above the Fed's target, can a fragile 60-day geopolitical ceasefire truly cure a 5-year macroeconomic problem? Keep a very close eye on the data, folks. Thanks so much for joining me for this explainer.